Welcome to the session on making investment decisions made simple. In today's session, we're going to have a look at how do accountants prepare annual financial statements and annual reports, and have a look at what you should be evaluating when you read a company's annual report. Once we've done that, we're going to go and have a look at the 5 key areas that accountants use ratios to measure your financial performance. So without further ado, let's head to the classroom. We want to start to look at them to see what stories the numbers are telling us. So there's a couple of things I wanted to show you. The first one is just to get clear on where finance fits in. So we say first part is getting the numbers. So we said by the 7th or the 10th of the month you should get your financial statements, your budget, have a look at it. So we want to assess the health of your department or your business using those numbers. We want to use that information to come up with some kind of a plan. So the first one we say is profitability. Is your business generating enough profit? So we say the first one we do it as the gross profit, which is gross profit divided by your revenue or sales. So that tells me how much marginal contribution do I have after I've paid my direct costs. So we don't have time to do it now with you, but you could go back and you could find those numbers. So not too difficult, hey? Can you see on your income statement your gross profit number? Yeah, it's there on your statement of consolidated income. Your sales or revenue number, you could go and do that maths. So your PE ratio simply says, how long will it take you to get your share capital back using profits? So if I bought a share for 10 Rand and I get 5 Rand a year in dividends, how many years will it take me to get my money back? So 10 divided by 5, 2 years, hey? So if I bought a share for 10 Rand and I only get 1 Rand a year, how many years to get my money back? 10. So we say the more established your business, the more years you've got to be prepared to pay for it. So if I buy something like South African breweries, it takes you a couple of years to get your money back. I don't know the exact amount, but it's about 7 years. Whereas if I buy a company that's younger, I should hopefully get my money back in a shorter space of time. I'd have to have a look. Actually, it'll be interesting because, with the passing of Steve Jobs, I wonder what happened to the share price.
It's gone back up. It's still valued the most valued company in the world.
Oh, wow. Hey, that's interesting.
I know with Facebook.
Yeah. Yeah. Well, Facebook, I worry about Facebook because there's no real asset there. Apple at least has got copyrights and brands, and there's something tangible, whereas Facebook is so subjective. What did they sell it for? Was it 200 billion or something ridiculous, hey? But what are you actually buying, hey? Yeah, interesting. Okay, so